Datadog Inc., the cloud infrastructure monitoring platform connecting engineering teams to full-stack observability across applications, infrastructure, logs, and security from a single unified agent.
DDOG generated $3.4 billion in FY 2025 revenue at 81% gross margin, growing 28% on accelerating enterprise demand for AI and cloud monitoring.
The story begins in 2010. Olivier Pomel and Alexis Lequoc co-founded Datadog in New York after building monitoring tools at Wireless Generation. The bet, developers, not IT operations, would own monitoring.
Datadog IPO'd on NASDAQ in September 2019 at $27 per share, raising $648 million. By 2021, revenue had crossed $1 billion, driven by rapid enterprise cloud migration.
In 2024, Datadog launched LLM Observability, monitoring AI model costs, latency, and safety at runtime. Q1 2026 revenue crossed $1 billion for the first time, with AI logo bookings doubling year over year.
Subscription revenue generates virtually all of Datadog's income, sold on annual contracts that expand as customers activate additional modules across infrastructure, APM, logs, security, and AI observability.
The Americas generate approximately 65% of revenue, with Europe and Asia Pacific contributing 35%. Over 3,000 customers pay more than $100,000 annually.
Gross margins held at 81% in FY 2025, software-native economics from a multi-module SaaS platform. Non-GAAP operating margin expanded as Datadog shifted from growth investment toward operating leverage.
Revenue grew 28% to $3.4 billion in FY 2025. Q1 2026 delivered a beat, $1.0 billion, up 32%, with full-year guidance raised to $4.3 billion.
Dynatrace is the primary enterprise competitor, deeper in mainframe and SAP environments. Datadog's developer-first approach and 17 product modules drive faster adoption across cloud-native engineering teams.
Splunk, now part of Cisco, competes in log management and security. Datadog's unified platform bundles what Cisco sells separately, driving lower total cost for cloud-native engineering teams.
Datadog's moat is a single agent collecting infrastructure, application, log, and security data simultaneously. Consolidating 5-point solution vendors onto one platform drives enterprise expansion and contract growth.
Datadog serves over 28,000 customers across North America, Europe, and Asia Pacific, monitoring billions of events per second across cloud, on-premise, and hybrid environments.
North America drives the majority of revenue. Europe is the fastest-growing region, with GDPR-sensitive enterprises seeking unified observability. Asia Pacific expands through Japan and Australia as cloud adoption accelerates.
Olivier Pomel co-founded Datadog in 2010 and has served as CEO since inception, guiding the company from a New York startup into the global standard for cloud infrastructure monitoring.
Pomel's engineering background, trained at École Centrale Paris, shapes Datadog's product-led culture. His bet that developers, not IT operations, should own monitoring became the platform's defining competitive insight.
Datadog, the cloud infrastructure monitoring platform, $3.4 billion in FY 2025 revenue at 81% gross margin, with AI observability as the next compounding growth layer.
Q1 2026 beat on both lines, $1.0 billion in revenue up 32%, EPS 60 cents versus 52 cents estimated, guidance raised to $4.3 billion, stock surged 29%.
Datadog just crossed $1 billion in a single quarter, revenue of $1.006 billion, up 32.2% year over year. GAAP EPS of 15 cents beat the 10-cent estimate. Non-GAAP beat too at 51 cents versus the 47-cent estimate. The AI observability wave has landed squarely on the income statement. I'm Hudson Thomas. This is Charged Alpha.
And I'm Lana. Datadog is the leading AI-native observability and security platform, monitoring infrastructure, applications, logs, and now AI models in a single unified interface. Founded in New York in 2010 by Olivier Pomel and Alexis Lequoc, the company went public in 2019 and has compounded revenue above 30% annually since. At $35 billion in market cap and $110 per share, Datadog trades at roughly 11 times trailing sales.
The platform now covers infrastructure monitoring, APM, log management, cloud security, AI observability, and more. Over 20 product lines that customers adopt sequentially. Average top customers run more than 8 Datadog products simultaneously. That land and expand architecture is why net revenue retention stays comfortably above 100% and why the company crossed the $1 billion quarterly revenue threshold today.
Revenue of $1.006 billion grew 32.2% year over year, beating the consensus estimate of $960 million by nearly 5%. The 5-quarter trend is the real story. 761, 833, 908, 935, and now 1006. Sequential growth is accelerating. The company grew more in Q1 2026 than in all of fiscal 2023.
Gross profit was $797.2 million, a 79.2% gross margin, essentially flat with recent quarters. Gross margin consistency in a rapidly scaling software business of this size is a structural quality signal. Every incremental revenue dollar drops through at nearly the same high margin rate, which creates enormous operating leverage as the top line compounds.
GAAP operating income was $7.3 million, a 0.7% margin. That sounds thin, but context matters. Datadog's GAAP operating line is heavily burdened by stock-based compensation. Non-GAAP operating income was materially higher, with non-GAAP EPS of 51 cents beating the 47-cent estimate. That 4-cent non-GAAP beat is the largest in 3 quarters.
GAAP net income was $52.6 million, earnings per share of 15 cents versus the 10-cent GAAP estimate. This is the beat the headline cited. Driving GAAP profitability, interest income on $3.5 billion in cash, plus disciplined expense management outside of SBC. The business is genuinely generating positive GAAP net income at scale, not just non-GAAP profit through exclusions.
Customer cohort data is where the bull case lives. Datadog now has more than 10,000 customers with annualized recurring revenue above $100,000 and over 1,000 customers with ARR above $1 million. That $1 million-plus cohort is growing faster than total customers, which means average contract value is expanding as the platform deepens inside enterprise accounts.
AI observability emerged in Q1 as a distinct and accelerating product category. Customers deploying large language models in production need tracing, latency monitoring, prompt logging, and model performance dashboards, all of which Datadog now provides natively. Management flagged AI as the fastest-growing use case by new logo acquisition in Q1. That is an entirely new addressable market sitting inside the existing platform.
The bull case starts with the AI observability moat. Every enterprise running AI models in production needs exactly what Datadog provides: end-to-end tracing from the user query through the LLM call to the back-end response, latency dashboards, cost per inference metrics, and anomaly alerts. Datadog is shipping these features faster than any competitor, and switching costs increase with every additional product a customer activates.
Platform expansion is the second leg. The Rule of 40, revenue growth rate plus operating margin, sits comfortably above 40 for Datadog, a threshold that signals durable, profitable hypergrowth. The land and expand model means each new customer cohort is worth more than the last. Over $1,000 million ARR customers paying and expanding across 8+ products create a revenue compounding engine that is difficult to replicate.
The valuation bull case rests on the forward earnings trajectory. Consensus projects non-GAAP EPS of $1.05 by fiscal 2027. At $110 per share today, that implies roughly 100 times forward non-GAAP earnings for 2027. Elevated, but defensible if revenue sustains 30+% growth and operating leverage continues to materialize the way Q1 non-GAAP margins suggest.
The free cash flow story reinforces the bull case. Trailing 12-month FCF is $1.4 billion, a 14% FCF margin on a $10 billion-plus annual revenue run rate. Datadog generates real cash. With $3.5 billion in cash on the balance sheet, zero major near-term debt maturity risk, and an accelerating AI product cycle, the company has every tool needed to press its competitive advantage.
The bear case starts with valuation. Enterprise value to sales of roughly 15 times is an unforgiving multiple. Any deceleration below 30% revenue growth would likely compress the multiple sharply. And historical precedent for cloud software derating in a macro slowdown shows how quickly 15 times sales becomes 8 times sales when growth disappoints by even 2 or 3 percentage points.
Hyperscaler competition is a structural bear argument. Amazon CloudWatch, Azure Monitor, and Google Cloud Operations are all deepening native observability inside their platforms. Enterprises consolidating cloud spend may accept good enough native monitoring rather than paying incremental Datadog license fees on top of their cloud bills. If the cost optimization cycle accelerates, Datadog faces pricing pressure at the platform level.
GAAP operating margin of just 0.7% is the third concern. Stock-based compensation remains heavy. That gap between GAAP and non-GAAP reflects real shareholder dilution. Bears argue a company at $35 billion should not need the SBC exclusion to show operating profitability.
Macro risk is the most immediate near-term threat. Cloud cost optimization, enterprises trimming usage across AWS, Azure, and Google Cloud, directly reduces the workloads being monitored and therefore Datadog's consumption-based billing. In 2023, Datadog guided down when enterprise cloud budgets tightened. If macro conditions deteriorate, a similar consumption slowdown is Datadog's most direct revenue exposure, and at a 15 times sales multiple, the downside is asymmetric.
Customer concentration in the 1 million plus ARR cohort is a double-edged sword. Losing even a handful of those accounts would visibly damage the growth rate. These customers are large enough to negotiate hard on pricing, and in a cost-cutting environment, Datadog's platform breadth can become a liability. Contracts get rationalized, product lines turned off, and ARR contracts negotiated down. Churn at the top cohort would hit reported metrics hard and fast.
Options activity heading into Q1 showed modestly bullish positioning, call buying on the AI thesis and the revenue milestone catalyst. Post-earnings, the stock responded positively as the double beat confirmed the narrative. Implied volatility compressed after results, a constructive sign the market is digesting results cleanly rather than pricing in ongoing uncertainty.
The balance sheet is a genuine fortress. $3.5 billion in cash against $2 billion in total debt yields a net cash position of $1.5 billion. Current ratio sits at 2.1, no near-term liquidity concern. Datadog funds its own growth entirely from operations and does not need capital markets access to sustain the current trajectory. That is rare at this growth rate and scale.
Free cash flow tells the real capital efficiency story. Trailing 12-month FCF of $1.4 billion represents a 14% FCF margin on a roughly $10 billion annualized revenue base. Operating cash flow in Q1 alone was $420 million. Price to trailing FCF is approximately 25 times. Not cheap, but rational for a business growing revenue 32% with improving FCF conversion.
Forward estimates project revenue accelerating toward $4.25 billion for full year 2026, implying roughly 28% growth from the 2025 base. Non-GAAP EPS of 72 cents is the 2026 consensus. By 2027, the Street models $5.2 billion in revenue and over $1 in non-GAAP EPS. If those milestones land, today's $110 share price looks like the beginning of a re-rating cycle.
Wall Street's read on Datadog is overwhelmingly constructive. Across 43 analysts covering DDOG, 20 have strong buy ratings, 16 have buy, 6 hold, and 1 sell. Consensus price target of $145 implies 32% upside from current levels, a wide gap between the consensus target and where the stock trades, which itself tells you how bearish the macro backdrop has been for high multiple tech in the first half of 2026.
Goldman Sachs, Morgan Stanley, Piper Sandler, and Barclays all maintained overweight or buy ratings post Q1, with price targets ranging from $140 to $160. The consistent upgrade thesis. AI observability is not a feature. It is a new product category with a multi-billion-dollar TAM expansion embedded inside existing enterprise accounts. On insider activity, CEO Paumel and co-founder Lei Kwok have maintained their equity positions under routine 10b5-1 plans with no unusual pre-earnings disposals, a signal of founder-operator conviction even as the stock sits well below its 52-week high. At 110, the discount to the 145 consensus target is the widest it has been in 3 years.
Datadog Q1 2026, $1 billion in revenue, 32% growth, EPS beat on both GAAP and non-GAAP, AI observability accelerating as a new product category, and a fortress balance sheet with $1.4 billion in trailing FCF. At 110 a share against a 145 analyst target, the market is pricing in macro risk, not the AI thesis. That is the Charged Alpha read on DDOG. This episode is for educational and entertainment purposes only and does not constitute financial advice. The information presented reflects publicly available data at the time of recording. Always do your own research before making any investment decisions. Charged Alpha is an independent financial media brand. Thanks for listening to Charged Alpha. New episodes drop every earnings season.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.